This conference will now be recorded.
Good evening, folks. My name is Tom Doncaster. I'll be your host this evening for the second part of four-part series concerning the 4 pillars of a successful retirement. And are you ready? So let's go ahead and get started here this evening. And let's address the second segment, which is involving income strategies. Hope you'll have a couple of pen and paper ready to take lots of notes, because we are going to cover quite a bit of material tonight. So exactly what happens when you retire? Well, the financial focus shifts, doesn't it? Goes from the accumulation of assets to more of the distribution or withdrawal of those assets, right? So we have to, in essence, possibly redo our asset allocation. And the primary objective would be to what? Live comfortably, right? And avoid running out of money, especially in this day and age, since people are living longer. We have more centurions living today than ever before. Plus, we also want to what? Generate some income while we maintain our principal. So that's also important because of inflation. And there's 3 steps to developing an income strategy. One is we size up the current situation and the sources of income. Second one is we refine the investment mix, as we said earlier. Probably the investment allocation has to change. And then we choose a plan for tapping the assets. Could be a bucket strategy, could be an investment type strategy, but we'll discuss that as we go on. So as we size up your situation, how do you want to spend your retirement? Do you want to travel? Do you want to, in essence, visit the grandkids? Do you want to do a, world tour? How do you support your desired standard of living? Probably you want to maintain it and maybe even enhance it a little bit. So if you haven't accumulated enough assets, you might possibly still have to work part-time or maybe even full-time. And whatever time is left to save more money and pursue more investments, then we can, in essence, focus on doing some leisure things, right? So we might have to modify our lifestyle during retirement. Now, you could need anywhere from 70 to 100% of your pre-retirement income to live comfortably in retirement. Most of the time, I mention to folks that they should target at least 75% of whatever their pre-retirement income was. And the sources of income could come from pensions, although they are disappearing more and more every day because it is very expensive to, in essence, fund those programs. Then there's also obviously working actively. Employment earnings, savings and investments obviously is going to be another item besides Social Security, right? So most people say, well, Tom, I'm just going to keep on working. So although nearly 3 in 4 workers expect to continue to work in retirement, only 27% of today's retirees actually do so. Why do you suppose that is? Well, in some cases, it could be a layoff that was not expected. Other cases, it could be some health issues where they're not going to be able to work as long as they thought and have to retire a little bit earlier with less investments. And in other cases, working to pay that can affect the Social Security benefits as well. So personal savings and investments, there are 2 basic types: tax advantage vehicles and taxable vehicles. Now, the taxable advantage vehicles are mostly your employer retirement plans, your 401ks, 403bs, your 457 plans, IRAs, and in some cases, annuities also fall into that same category. Taxable vehicles, you'll be able to distinguish those because you're going to get a 1099 every year for those, right? And that's because you have to pay tax on whatever the earnings are on that account. Could be a brokerage account, could be a CD, a bank savings, or other non-tax advantage vehicles in which we have to, in essence, declare the gains and pay the tax. So how do we refine our investment allocation? Well, a systematic approach to doing that is through diversification, which is in essence an efficient mix of assets for you. Now, here's a sample of some asset allocations for a conservative investor versus an aggressive investor. And if you'll notice, the conservative investor has 50% in bonds, 30% in stocks, and 20% in cash equivalents. Whereas an aggressive investor is 75% in stocks, 20% in bonds, and only about 5% in cash alternatives. Everyone's a little bit different because as we go into retirement, we want to make sure that we maintain that principal and not lose it through to market volatility. So that's important to, in essence, readdress probably once every 6 months. Now, a 20-year performance, to give you an idea on a conservative versus an aggressive portfolio, is not that huge of a difference. If you'll notice, the average annual return for a conservative portfolio that we just outlined is about 5.5, whereas an aggressive portfolio could be a little closer to 6. So while that 0.5% does make a difference, you have to ask yourself, do I really want to take that additional risk just for an extra 0.5%? So you have to choose a well-diversified mix of assets that you will feel comfortable with, right? Cash alternatives to preserve your principal, bonds for stability and income, stocks for growth because we want to keep pace with inflation, could be mutual funds and ETFs, exchange traded funds, for a variety of other goals as well. So primary retirement objective is generally income. Those would be covered by bonds, income-oriented ETFs or mutual funds, dividend-paying stocks, and even some tax-exempt investments. Bonds are basically an IOU. It's an unsecured IOU, which basically means, hey, you're going to turn over that money to this particular investment firm or a company, and as long as they're viable, they promise to pay you some type of a return or a coupon dividend rate. If at the end of a certain period of time, the company's still viable, then you get your principal back over and above whatever dividends or coupon rate you might have received. Or if they're not viable and they have gone into receivership or bankruptcy, then all could be lost. So keep that in forefront of your mind there. There are some risks with bonds, although some people don't think there are. There's what's called interest rate risk. As interest rates starts to rise, and let's say you bought a bond for 20 years at 4%, well, that's going to still continue to pay you that 4%, even while other alternative investments might be yielding a higher return. So consequently, if you had to cash that bond out early, in other words, before the 20th year or whatever time frame you locked it in for, you might wind up having to take a little bit of a haircut. So be real careful. Then, as we mentioned earlier, there's also the default rate risk. Issuer cannot make promised payments and they default on paying you the dividends, and in some cases maybe even not return your principal. Then there's also the credit risk. The bonds may lose value due to a lower credit rating. There are such things as investment grade bonds as well as non-investment grade. And the way that you can tell is generally non-investment grade bonds will illustrate or promise a higher dividend rate of return, higher yield, assuming that they're still viable. So one of the things that some people do to, in essence, maintain some type of risk assessment or management on those bonds is that they will layer the bonds. In other words, they'll buy some for 2 years, then they mature and they have to repurchase another one, 4 years, 6 years, 8 years, and even 10 and 20 years. That's a way of saying, okay, I've got a certain amount of interest rate coming in for 2 years or 4 years and 6 years. And then when it matures, we'll have to repurchase a different bond for either that same period of time, hopefully for a higher rate. But let's face it, folks, we haven't seen high rates of return on CDs, money market, and even bonds for the last, 15 years. So once again, be cautious. Income producing mutual funds and ETFs are another alternative. Generally, you can get into those for a lower initial investment. You don't have to come up with, say, $10,000 or $20,000. You could go in for as little as $1,000 to maybe $5,000. They are professionally managed, and in most cases, they are internally diversified with 40, 50, maybe even 100 different bond holdings on there. So there is some flexibility. And if all of a sudden an emergency arises and you need to cash out before say a 5-year or a 10-year bond, you're not going to take as big of a haircut most of the time. However, one of the things that you need to be aware of is that bonds that are in a mutual fund, just like a stock that's in a mutual fund, are passive investments. They are professionally managed, but they're not actively and tactically managed, just passively managed, which means that the money manager, whoever that is, will probably realign the portfolio once every 6 months, twice a year, okay? Now, dividend paying stocks are another way of generating some income for retirement. Some stocks distribute some of their profits as a dividend. And if profits decrease, well, the dividend could also be cut. We saw that happen a couple of years ago when we initially saw the pandemic hit. You know, some companies were in essence disrupted, and so they had to either reduce or stop paying their dividend for a period of time. However, they can provide an element of potential growth as well, as long as the market is performing well. And value fluctuates with the changes in the market conditions as well. Then there are tax-exempt like municipal bonds, which the dividends are 100% federal income tax-free, and it could be some treasuries, could be also tax-free money market mutual funds, typically offer a lower yield than taxable investments. So, you know, do your homework when it comes to that, or perhaps you may want to hire a professional like myself to help you guide you through that maze that's out there. Now, one of the things that you need to be aware of is that the tax-exempt vehicles, while they may not be taxing them directly, it does count towards what's called provisional income when it comes time for you to retire. And as you're collecting Social Security, that's going to determine what percentage of your Social Security they will probably tax. Could be anywhere from 50 to as high as 85%. More on that a little bit later. Now, tax-exempt investing, even though you might get a little bit lower yield, depending on the tax bracket, is going to determine whether it's advantageous or not. So if you'll notice on this slide, if you would be, let's say, in a 24% tax bracket, and you're getting a tax-exempt yield of 4%, in order for that to be equivalent to a taxable account, you'd have to be making a little over 5.25%. Whereas if you're getting a 5% tax-exempt yield and still in a 24% tax bracket, that would be equivalent to about 6.58%. So don't discount them just because the yield is lower. In many cases, it might be well worthwhile considering. Now, choose a plan for tapping those assets, okay? So in some cases, you know, you're going to have to determine based on your longevity, based on your family health history, how long you want that portfolio to last. Most of us, obviously, it would be wise to assume that you're going to live till age 100. As I said earlier, people are living longer. And so if you happen to pass away at 90 or 95, that's fine. At least you don't have to, in essence, be concerned with what am I going to do if I'm out of money at age 90 or 95. So as long as you plan towards age 100, and typically it's assumed that a 4% may be conservative to withdraw from those accounts. So let's assume that you have two $500,000 tax deferred accounts, and you want to, in essence, have 50,000 of inflation adjusted annual withdrawals. And let's also calculate a 3% annual inflation rate, okay? Because we know what a dollar is going to pay for today, it won't 5 and even 10 years down the road. So this is an example of what would happen if you had a 4 versus an 8% return with those, you know, assumptions. Your, in essence, your money at 4% could last a little over 10 years, whereas a 8% return might be more like 14 years. In either case, it's generally a good idea to reassess and reallocate your portfolio as needed. Then, of course, we have to deal with the volatility of the unpredictable markets. You know, sequence of returns is a term that some of you may be familiar with, and that's when you are experiencing poor investments returns at the wrong time, mainly when you're withdrawing from your investment account and investment portfolios are in negative territory. It doesn't take a rocket scientist to figure out that those type of sequence of returns will have you run out of money prematurely. So be real careful on that. And selling assets during a downturn could result in a faster depletion of assets. So once again, you don't really want to be doing that, and you should really have maybe perhaps a bucket approach of some money in guaranteed accounts, some money in non-qualified accounts where you don't have to withdraw money, and then obviously some in tax qualified accounts, which, as you know, the new required minimum distribution for all qualified accounts is now age 72, not 70 and a half anymore. But that would help if you have a diversification of different classification of assets. So how can an investor do? There's no perfect strategy, is there? Nope. There's no such thing as a silver bullet, although some people will probably try to tell you that. And the decisions that you make to draw down assets will largely depend on three factors. And those three factors would be what? The value of your portfolio when you retire, the actual investment returns, and the amount and timing of withdrawals. So in some cases, if you experience market volatility, you may have to stop taking withdrawals for a certain period of time, 3 months, 6 months, maybe a year, perhaps longer. So withdrawal strategies, let's take a look at some of those. Folks out there have been using the 4% rule up until about 3 years ago. There's a book out there that you may want to purchase by Dr. Wade Pfau, and his last name is spelled P-F-A-U, Pfau. He wrote a book called How Much Can I Spend in Retirement? And one of the things that he outlined in that book was that the 4% rule might be a little too aggressive because of all the market volatility that we've experienced over the last 5 to 10 years. He mentions in his book that it might be wiser to take out 2.8 or 3%. Then there's also the endowment method, where in essence you build up cash up to a certain point, and whatever that amount adds up to, you're going to, in essence, withdraw over a set period of time, 10, 15, 20 years, and then the money is depleted. Or you could use a life expectancy method, which, as I mentioned earlier, probably should utilize age 100 because you definitely probably don't want to go back to work when you're 85 or 90. And then there's the three-tiered strategy, like a bucket type strategy where you have some that's cash equivalent, bond equivalent on the second one, and the third one could be for growth for inflation protection on your principal. In either way, the 4% rule was developed back in the 1990s. And back then they were saying that if you withdrew 4%, regardless of what your return was in the 90s, which if you recall back in the 1990s, didn't take very much planning to wind up with a 10, 12, or a 15% return. And the assets could last potentially about 30 years. And that was using an assumption of a 50-50 portfolio mix of stocks and bonds in a tax-deferred account. And based on historical market performance, which obviously cannot be guaranteed, generally there'd be nothing left for legacy after the 30th year. But the advantage would have been consistent income, and it would be adjusted for inflation. The disadvantage is market downturns just before or early as you go into retirement could have a great impact. So it does not take into account the ever-changing factors. So keep that in mind, and that's probably why Dr. Pfau recommends 2.8. So how long could $1 million last in retirement? Well, based on the rate of return and withdrawal, here is an assumption here that takes a 5% annual rate of return, which is a good estimate for this day and age, even though I know in some cases some of you are making more than that. There will be times when there will be an adjustment in the market, or as the media likes to call it, a crash. And then if you're still withdrawing money from an account that's in negative territory, what did we say would happen? You're going to wind up depleting some of that principal a little bit earlier. But on the slide here, $1 million with an $80,000 withdrawal is expected to last about 15 years, whereas one that's $60,000 withdrawal, about 21 years. And if you did a $40,000 withdrawal, then that would be more like 35 to 36 years. So I would say somewhere between the 60 and the 40 is probably somewhere where you might want to target that. But then again, there's also taxes that we'll talk about as we go down the road here. Now, the endowment method is that you withdraw a target percentage each year, and it's a modified method. You establish a ceiling and you establish a floor. So the example would be 5%, whereas 3% would be the minimum, right? And the advantage, theoretically, is that your portfolio will never, ever be depleted, okay? That's as long as it's in positive territory, making money and not in negative. The disadvantage, once again, is the unpredictable income each year, because you might have to go from 5 down to 3%. And if it's based on, say, $50,000, well, then that can make a difference of about $10,000 less per year. And if you're on a fixed income, as most people are during retirement, that means you might have to cut back on certain things. Probably no travel, maybe reduce the amount of time that you spend with the grandkids. You might have to fly them in instead of you having to go visit them, or vice versa. And it doesn't adjust for inflation. So that's a little bit slight drawback on the endowment method. Now, the life expectancy method is you withdraw an increased amount based on your life expectancy. Now, most folks are expected to live 20 to 25 years into retirement. So as an example, divide the portfolio, the value, by your life expectancy each year. So if you're using 25 years, you take 1 divided by 25, and that tells you you should use a 4% withdrawal. Whereas if your life expectancy is more like 20 years, then it's 1 divided by 20, and that's a 5% withdrawal. So advantage, withdrawals percentage increase each year, theoretically, and your portfolio supposedly will never be depleted. Disadvantage is that poor market conditions, once again, can reduce the income amount and possibly lower the withdrawals in most of those active retirement years. And usually the most active retirement years are your first 10 years, from mid-60s to mid-70s. That's what's often referred to as the go-go years. And then the next set of 10 years, from say mid-70s to mid-80s, are referred to as the slow-go years, because we're starting to get a little bit older. And then beyond age 85 to say 90, 95 are usually referred to as the no-go years, because that's generally when we start having all sorts of ailments. We can't get around. We need assistance of walkers, of wheelchairs, that sort of thing. But if you've taken care of yourself, you may not have that situation. Never know. So the 3-tiered strategy is you divide your portfolio into 3 buckets or 3 tiers. First tier is for short-term, 2 to 3 year money, right? Conservative assets that you could draw on, regardless of the market conditions, such as a CD, a money market account, or maybe even an annuity. You know, that's something worthwhile considering. Most people overlook them because they're going on misinformation that has been, distributed out there for many, many years, and folks haven't really studied how they've changed. So word to the wise, do your homework. Tier number 2 is a medium type of a trend of 3 to 10 years, mostly with fixed income vehicles and possibly a few dividend producing stocks. And then the long term, that's 10 years or longer, those are primarily growth stocks. So advantage is a manageable long-term strategy that provides a way to balance current income and some future growth. Disadvantage requires active management, not passive. Remember what I said about some mutual funds and ETFs? They're passive. It does require more of a tactical and active approach, so you probably would need to hire a professional. And it depends on market performance as well. So it may be challenging to coordinate. So you definitely may want to hire a professional to do it. Now here's an example of the Millers. They used a 3-tier strategy. Their initial investment value was $850,000. Annual goal from that was to take $45,000. And so they used that 3-tier approach, right? So the 3rd tier, which was growth, and they calculated a 6% growth, which I think that's conservative. Roughly of that 850,000, a little over 474,000 went in there. 2nd tier had 169,300, calculated at a 4%. And the number 1 tier, which was mostly cash equivalents, short-term money, had a 3% growth. So, and they basically estimated that based on a $45,000 withdrawal, pro rata from each one, right, that the first one wouldn't be depleted until a little after 5 years, whereas the other one would go beyond that, and the growth stocks hopefully would last beyond 10 years. Now, these are hypothetical examples, so your situation could be different. portfolio and retirement plans. So it's not an easy decision, is it? Well, no. A lot of things have changed. And in the 33 years that I've been in this financial services business, what we were doing 30 plus years ago versus today is 180 degrees different. So make sure that you either hire somebody or you do your homework, or possibly a combination of both, because you definitely don't want to run out of money as you go into retirement. The considerations are definitely going to be tax consequences. You know, today we're in a very low tax bracket, the lowest I've ever seen, and I've been working for over 40 years. There's also opportunity costs that have to be taken into account, and then the emotional implications. So if you have this, what I would call having a condition that's referred to as running to the Mealox bottle quite often, you definitely want to hire a professional to help you, because in many cases I've seen folks make some very serious, dire mistakes because they've allowed their emotions to run away with their thought process. And let's face it, when we have fear and when we're angry, we don't generally think straight, do we? Let's be honest about it. So we probably could use a separate outside entity that is impartial to help us and guide us through some of these ups and downs of the market. Taxable versus tax deferred and tax-free accounts, I think, make very good sense to balance those assets into those different asset classes, as well as having the internal diversification of the asset allocation mix. So what should we use as we go into retirement first? Should we consider the taxable accounts? You know, those could be securities or brokerage accounts held in a taxable brokerage account. Could also be CDs and bank savings accounts. You might want to consider using assets with the highest cost basis first, you know, because that is some tax efficiency there, and then leaving tax deferred assets untouched and allow them to pursue potential tax deferred growth. Well, once again, that might be a way of doing it for some people, but it all depends on the amount of funds and value that each of those different asset class categories have. Because as you know, when you reach age 72, those tax qualified accounts have to start with what's called the required minimum distribution. And if you have at least $1 million or more in a tax qualified account, when you reach age 72, that first year distribution is going to be about $38,500. And the IRS uses a mortality table that says that you're going to live at least 15 to 16 years. So as you get closer and closer to those pearly gates, that amount continues to increase every single year. So make sure you do your calculations. Winners versus losers. Well, liquid, highly appreciated assets generally are recommended to go first as far as a withdrawal, right? You don't want to take what's losing money out first when you can take out some profits, right? That helps to, in essence, not deplete the account early. And it may help to rebalance and take advantage of higher earnings depending on where the market is and where your individual positions or positions in your portfolio are performing at. So if leaving a legacy is a goal, which it might be for some, you may want to consider this approach. You know, some inherited assets receive a step up in cost basis, which are usually the non-qualified plans, kind of like your home, right? And you could also use a combination of approaches that also might work a little bit better. Now, if it's not important to leave a legacy for the children, you know, folks have asked me what I've done. Well, I've told my 4 sons that if there's anything left over after their mother and I are done, it'll be because I made a miscalculation. No, just kidding. But, you know, it's important to let them know what your, you know, goals are. There are different retirement plan options out there. You could leave your money in a current plan until needed or until required to begin your distributions. It's not always a wise idea to roll over from a qualified employer plan to an IRA. Sometimes it is, sometimes it isn't. So weigh those options. Roll over money into a new employer's plan is another option if you are continuing to work. And if you do that, as an example, let's say you could move your 401k from a prior employer to a new employer, and let's say you decide to continue to work even beyond age 72. Are you aware that if you do that, and if you have your qualified retirement plan with your current employer, you are not required to take out the required minimum distributions until such time as you retire. Bet you didn't know that, huh? Well, that's one of the reasons why you want to hire a professional that keeps up with all the most up-to-date current tax rules. Roll money over is one. Distribution options, lump sum. Today, more and more companies are eliminating their pension plans and encouraging the employees to do a rollover, because really, at the end of the day, a pension rollover on the side of the company is a liability to them. Whereas to you and I, a pension is actually an asset. So if they can get rid of that and have you self-directed, they eliminate that liability of having to tell you one day, whoops, we made a mistake. We're going to have to cut your pension payment by 30, 40, or 50%. Kind of like what happened in Detroit. Remember, they all took what, a 20% reduction because their pension was in dire straits. Now, is it always a good idea to take a lump sum? Sometimes it is, sometimes it's not. Myself as a fiduciary, I generally will run the numbers based on the information that our employee is going to give me so that I can do an assessment of whether or not it's wise for them to just take the pension monthly payment or do the rollover. Because at the end of the day, when you do the pension rollover, you have control of the principal. Whereas when you take the income, the monthly annuity payment, you no longer have control of that principal. So in today's tax environment, you may want to run the numbers. Systematic withdrawals are another option. Lifetime annuity is another potential option, which is really what Social Security is. It's an annuity payment, just like a pension monthly option as well. They're going to an insurance company, and that's how they calculate what you're going to receive. Or is it wise to roll over to an IRA? Could be in some cases. Lump sum distributions, give you immediate access and you can control the funds. The downside is that income taxes are due if you take possession of the lump sum from that qualified account. Whereas if you do a trustee-to-trustee transfer from whoever has it to a new custodian, you don't have to pay any tax immediately until you start withdrawing from that account. Systematic withdrawals specifically, they in essence give you some possible payout options. It could be a fixed dollar amount on a regular basis. It could be a specific percentage based on what you feel comfortable and what your objectives are for retirement. And the total value of the account in equal distributions over a specified period of time is also another option. It could be done on a monthly, quarterly, semi-annual, or even annual basis. Now, a lifetime annuity, just to give you an idea, gives you guaranteed regular payments, and it'll last for as long as you're alive or as long as you and your spouse are alive, and in some cases even to a beneficiary, depending on how you structure them. And the disadvantage are that, unfortunately, payments are not indexed for inflation, so most of the time they work like a pension payment. And I would say, with the exception of the state of Washington, state retirees, most pensions don't have any kind of inflation increase. And the decision is usually irrevocable. So once you cash that first check, that's it, man, you're stuck, can't change it. So definitely do your homework on that. Now here's an example of a lifetime annuity payment, okay? Single life, which pays out the most to that individual, is $1,600. And it will pay out for as long as they're alive. Once they die, there is no survivorship benefit for anyone. Now, this is a community property state in Washington. So in order for an employee to be able to take that, or in essence, an annuitant to take that, the spouse has to sign off and it has to be notarized that she understands what is going to happen, or he understands what is going to happen whenever the primary annuitant passes away. So in most cases, what I see people taking are either a joint 100% or a joint 50% survivorship option. In this particular example, it would be 1175, 100% joint, regardless of who's alive. Pays out as long as one of them is still alive. And when the second death occurs, that's usually where it all stops. Whereas a joint 50% survivor, in this case, it would be $1,500 for the main annuitant while he or she is alive, And once they pass away, the survivor gets 50%. You got it. There are others in there where some of them will do 75, but that's in essence the most common ones out there. So which distribution option is right for you? Well, it's going to have to be based on your age, what your liquidity needs might be, and whether or not you're going to be able to handle that Maalox moment. Market volatility. Is it important to preserve your funds, your principal? What are the income needs, and what about your tax situation? As I mentioned earlier, if you're not careful, you could wind up pinning yourself into a corner where you already know that your pension amounts are going to be taxable. Your 401ks, your IRAs are all taxable. And if you're not careful, you could wind up having your Social Security taxed all over again. Not to mention what your Medicare Part B premium could be, because that is also predicated on your income, which half of the people out there know and the other half don't know. More on that a little bit later. Now, IRA rollover. The advantage to that is that you can continue tax deferral, right? Because an IRA, you can transfer money from a pension, 401k, 403b, 457 plan, and that continues a deferral. And there's nothing that says any of the money has to come out until, that's right, age 72. And generally they offer more investment options than a employer plan does. And you can consolidate the assets from multiple accounts into one big jumbo IRA if you want. Required minimum distributions now start at 72 on a traditional IRA versus age 70 and a half. So IRA rollover, possible drawbacks, okay? Limited creditor protection with IRAs in certain states. Now in the state of Washington, there is a limited amount of creditor protection on IRAs or any other qualified monies. There's only one entity that you cannot be protected from, and that is, yes, you guessed it, the Internal Revenue Service, okay? Unique investments sometimes offered only in the employer plan, so that's something to consider. What am I going to have if I leave it with my employer plan versus what can I get in IRA options out there? Cost considerations, typically when you roll out of a big company qualified account, the fees are going to be probably pretty low, next to nothing, because they're pulling your money together with all the other employees. So if you have 5,000 to 10,000 employees, your fees are probably going to be what, maybe 1/4 to 0.5%, whereas on an individual plan, it could be anywhere from 1 to 1.5. So something else to consider. And in some cases, if you're not 59.5 years of age, there are early distribution penalties from both an employer plan as well as an IRA. Now, there are some exemptions to that, which we'll talk about that a little bit later. And as we said, the RMDs have to be taken out, because if you don't, there's a 50% penalty from the IRS. And you have to take your very first one on April 1st, following the year that you turn 72. So timing could affect your tax situation. So make sure you do your homework once again. And failure to take the required amount, like I said, could result in a hefty penalty. Yes, 50%. They're not taking any excuses unless it's something that was unforeseen, say a health situation, hospitalization. Oh, I'm sorry, I forgot, doesn't work anymore, okay? And how are the RMDs calculated? Well, IRS uses a life expectancy table, and it is covered in the publication 590. So if you haven't picked that up either online or at the local IRS office, I would encourage you to do that. Typically, it says that a male retired in their mid-60s is expected to live about 16 to 17 years, whereas a female is expected to live more like 18 to 19 years. So all depends on your, sex and age. So should you consider a Roth IRA? Well, in some cases, I think it makes very good sense to do that. Now, as you know, funding for a Roth IRA is with after-tax contributions or a conversion from a regular traditional IRA or even a 401k. And the qualified distributions are tax-free once it's converted and once you've, in essence, started this plan and then generally kept it for 5 years or longer. Contributions, but not earnings, can be withdrawn at any time. And they're not subject to required minimum distributions, such as a traditional IRA. So keep that in mind. Although when you do a conversion from a qualified plan, you got to pay the tax the next following tax year from a separate account. IRS code says that it cannot come from your traditional IRA account. I know that some people are doing that, but if you ever get audited, you're going to have to pay the piper. So be careful on that. It has to be from another outside source, like a savings account. Roth IRA, other considerations. Well, assets can be converted from a traditional IRA or an employer plan, and then the income tax will be due the year of the conversion, okay? So if you did a conversion today, by April 15th of 2022 is when the tax would be due on that. And future growth would continue to be tax-free. It's a good tool for legacy planning, because at the end of the day, what kind of money is usually best to leave to your beneficiary or to your survivor? Taxable or tax-free? Think about it. Now, annuities often get overlooked, as I said earlier, because of all the misinformation that's out there. And I can tell you that based on what they were 30 plus years ago versus today, huge difference, folks. There are three kinds, actually four, but two of them are in the fixed category. One is variable, and then there's also an indexed annuity contract. So fixed annuities, they're predictable. They have a predictable income stream. They're an insurance-based contract, and it has an option for guaranteed lifetime income. Rates are fairly competitive. Right now, your traditional fixed annuities are paying, like 3.5 to 3.75 on a 5-year contract, which beat most CDs out there. It does grow on a tax-deferred basis, just like a qualified plan does. And there's no federal contribution limit, so you can put 50, 100,000, $1 million, whatever the company will, in essence, approve you for. And there are no mandatory distributions on a non-qualified fixed annuity. Non-qualified meaning that you've used after-tax dollars to, in essence, generate it versus qualified assets like an IRA. The rules are different. Now, types of fixed annuities. Here's where I was mentioning there's two different kinds here. There's an immediate and there's a deferred. We just discussed the deferred. An immediate annuity would be what most people think about whenever the word annuity comes up. And that is, you take a principal dollar amount, you pay it to the insurance company, give up control of that principal in return for guaranteed lifetime income for either you and a spouse, or you and a spouse and maybe a tertiary beneficiary. So it depends. Is it a good idea to give up control of principal? Well, depends. You'd have to discuss that. Some cases it is, some cases it's not. I've only done about 4 or 5 of them in the 33 years that I've been in the business, so it doesn't come up very often. So why is an immediate annuity an attractive option? Well, protects you from outliving your assets, for one, provides a continued stream of income to you, your spouse, beneficiaries for his or her lifetime, and it can provide a legacy planning benefit as well. So that's one of the attractions to it. Now, how does an immediate annuity work? Well, as I said, it's going to pay you out over a set period of time. And when you receive that payment, there's a return of principal, and then there's also the calculation for interest. So from a tax perspective, this is why some people also consider these contracts, because it does help to mitigate some of the risk involved in taxation. So in this example here, we're taking 100,000 with a 3.5% return, and let's say that the payout is over 20 years, right? So that would be roughly what, $6,960 annual income, of which $580 per month would be what? Tax-free, and only $1,960, which is $163 per month, would be considered to be taxable. So that's one way of controlling your taxable liability. Now, there's also something that started back in July of 2016, It's referred to as a qualified longevity annuity contract, QLAC, QLAC. It's a type of a tax-deferred annuity that may be offered in an IRA or in an employer-sponsored retirement plan. And what it does is that it guarantees income starting at an advanced age, such as 80 or 85. Now, the rules today are different from when they started back in 2016. Back then, it was only 120,000 or 25% maximum of the amount that you're, in essence, getting the money from. It has to be IRA or qualified retirement plan through your employer. Now it caps out at 135,000, still at 25% of the amount that's in the account. And QLAC value is excluded from any remaining balance used to determine the required minimum distributions. That's a big plus in many, many cases. So it's something to at least run the numbers and see if it would benefit you from that perspective. Payouts from a QLAC are fully taxable. But let's say that you, in essence, took one right before you turn age 70, and you said, hey, I'm going to defer the payment for 15 years, because you can either do 5, 10, 15 is the maximum. So that means that by 85, the money has to start coming out. What some people have said is that they're going to do that so that they can use that portion of money to pay for what? Expected higher healthcare needs, such as what? Critical care, long-term care, prescription drugs. It's not a question of if, it's more of a question of when, for how long, and how much. So consider that. The variable annuities, for the most part, as the other type of annuity that generally gets a very bad rap, because at the end of the day, people do not understand how the fees are assessed internally. I'm going to explain to you how they work. They offer variable returns based on the sub-accounts or investments that you pick. Some people refer to them as a mutual fund, and it looks, walks, and smells like one, but they're technically referred to as a sub-account. There's a wide variety of those offered, anywhere from 50 to 75 to 100, 120. It depends on which company you pick. And they may outperform a fixed annuity, but they may also not, because once again, they're subject to market volatility. You bear the risk, just like you would in a brokerage account. And the fees on a variable annuity, just to give you an idea, there's 3 embedded fees in there. One is what's called an M&E charge, mortality and expense. And typically that's going to be anywhere from 1.2 to 1.35%. And the mortality and expense is referred to as the guaranteed death benefit. So as an example, if you put in $100,000 and all of a sudden 5, 10 years down the road, the market takes a big gash out of it and it's only worth 50, you open up your statement, you have a massive coronary because you've just lost more than half of your money, you drop dead. What does your beneficiary get? 50? Or the 100 that you initially put in? It's the 100 that you initially put in. That's what that M&E charge is for. Then in some cases, some of these contracts have what's called an income rider. Could be 4%, could be 5%, could be 6%. And so based on the deposit that you put in there, let's assume 100,000, and let's say you purchased one that guaranteed a 5% income rider, that means you could start taking what, $5,000 a year out of that 100,000 for as long as you're alive, right? And the guarantee on that is that even if the 100,000 were to go to zero because of market volatility, because you chose the wrong investments at the wrong time, whatever the reason, right, you still continue to get that 5% based on the highest anniversary value. Now, in this case, we said we would start immediately, right? So conversely, if you put in 100,000, it grew to 200,000, and then you started taking out the 5% based on that 200,000 anniversary value, then that's more like $10,000 that they're going to pay you per year, right? And once again, even if the 200,000 decreases, go down to zero, not a problem. You still continue to get that 10,000 until the day you die. And that can also be set to, in essence, include a spousal continuation option. More on that later. And then finally, those sub-accounts, just like in a mutual fund or an ETF, those money managers want to get paid, for constructing that portfolio of that sub-account. And that could be anywhere from 0.5% to as high as 1.3, 1.4, depending on whether you're, in essence, electing domestic, global, or international equities. No free lunches, folks. But that's why folks say the fees are too expensive, and they don't take into account that they're just subdivided based on how you structure it. Now, the index annuities have only been out about 17 to 18 years now, and their performance is linked to an index. Losses generally limited by the guaranteed minimum rate of return. Participation rates are set by the insurance company. So as an example, an 80% participation rate means that contract holders would receive only 80% of the gains experienced by the index. So let's make it even simpler than that. Let's say that you bought one and it gives you a floor that you cannot lose your principal. So 0 would be your worst case scenario, meaning that let's say you put the money into, say, the S&P 500 index, and let's say the index went into negative territory like it did back in 2008, which was negative 38%. So we know that in order to come back up to even Steven, when you have a negative 38%, you'd have to make close to what? 55% return the next 12 months. Doesn't happen very often, does it, folks? So the 0 as your floor would protect you from your money going into negative territory. So it would flatline for that year, meaning that you wouldn't make any money, but you wouldn't lose any either. And then on the top side, if your participation rate is 50%, let's take the example of what happened last year in the S&P. Last year, the S&P did 16.2, so you would have made what, 8.1%. Not bad for a contract that doesn't have any risk on the downside, right? 2 years ago, the S&P did what, 28.1%. So you would have made what, 50% of that, 14%. Not bad. So typically the fees internally on an index, it could be anywhere from 0.75% to maybe 1.25%. Those are the averages out there. So I would say you may want to consider it, if for nothing else, maybe use it to replace your bond portion of your portfolio. Have some kind of guarantees, Now, 3 steps to develop an income strategy. One is you size up your current situation and sources of income, right? How much you're getting from pensions, Social Security, other maybe, rental properties, qualified accounts, brokerage accounts. Now you need to refine your investment mix from time to time because once again, as the accounts grow or they don't grow and they deplete, you need to, in essence, readjust that, right? And you got to determine a plan for how you're going to tap into those assets. You're going to be the tax qualified ones first, the taxable ones, the tax-free, or maybe a combination of all 3. Everyone's a little bit different. So the next session, we're going to discuss, I should say, tax planning and legacy, which will come back to a little bit of Social Security. We're going to, in essence, as we discussed, we covered the income strategy today, but the third one is going to be tax planning and eventually legacy planning. So keep that in mind, folks, because you don't want to miss next Tuesday night's presentation. So for now, we're going to bid you well. If you need to get a hold of us, our telephone number, if you have any questions, is 509-735-9518. If you want to email me, it's Thomas Doncaster, ThomasDoncaster. It's all lowercase run together at msn.com. Or if you prefer to visit our website, that would be www.tomdoncaster.com. In any case, I want to thank you for taking time out of your busy schedule to go over this exciting material, and we look forward to possibly hearing from you. Have a great evening, folks.